All right, Matt Gougé, Get Better Everyday Podcast. Special edition today. I'm going to be solo. I've got producer Matt in the background. He's going to fire questions at me. He's going to fire the top 10 mortgage questions according to ChatGPT. I know these are common questions that a lot of you have, and so I'm excited to dig into these and give the best explanation I can based on 10 years of experience funding hundreds of millions in originations, working with over 1,000 clients and talking to probably tens of thousands of clients in that 10-year period. Let's jump into it, Matt.
How much can I afford to borrow for a mortgage?
All right. How much can I afford to borrow? What do I qualify for? Super common question. And the thing about this is it's a moving target because mortgage interest rates are changing. One thing I will say is if you truly are looking to buy something, even if it's a year out, I think it's highly encouraged by myself and others to go and get yourself pre-approved. It doesn't cost you anything. And by providing income documents, having even a soft credit pull done, having all your information looked at, reviewed by a great mortgage broker is going to be something that is super valuable to tell you exactly what you qualify for. Now, I know people are just like, you know what, Matt, I don't want to go through that. I just want to have a rough idea. And I'll give you that as well. If you don't want to go to greatmortgagebroker.com, talk to me and my team, get yourself pre-approved. You can know a rough estimate of what you qualify for if you go anywhere online and you just look at like, what's today's mortgage interest rate? You take that 7% and then you times that by, any amortization schedule out there is going to tell you if I borrow $400,000 at 7% over 30 years, what's that payment? Well, you've got to take that payment. You've got to add mortgage insurance. If that's applicable, you got to add homeowners insurance. You got to add property taxes. Now you've got a full mortgage payment. Let's say you did that math and you got yourself to $3,600. Well, when it comes to mortgage qualifying, your mortgage payment versus your income is probably going to have to land in the 35 to 40% range, depending on loan product, but that's a good, safe place to land. So if you make $10,000 a month, that mortgage payment by itself probably shouldn't exceed $4,000. One, for qualifying, and two, because you just don't want to put yourself in a mortgage payment that's not comfortable. Now, mortgage qualifying also takes into account all the other debts that you have. And so mortgage payment plus other existing debts that show up on your credit report is going to all factor into what's considered your back end ratio. The front end is just the mortgage payment. The back end ratio is mortgage payment plus all the debts. And that's versus your income. So in the example of $10,000 a month in income, you've got a $3,600 a month mortgage. You've got $900 more in car payments, student loans, credit card minimum payments, whatever that is that factors in there. And now you've got a 45% back end ratio because $4,500 a month between new mortgage you're applying for and your current debts versus the $10,000. So you could do some rough napkin math to figure out kind of what you qualify for. And I spoke to somebody recently. If you've got very little debt, maybe just take that mortgage payment that you've hand calculated and divide it by 38% to get what income you would need to qualify for it, or do it backwards. Take your income and multiply it by 38% and say, that's my target payment kind of max that I'm going to qualify for. That's rough. But to get a clearer number, again, you're going to have to go to greatmortgagebroker.com and fill out the form and connect with the team.
What is the difference between fixed rate and adjustable rate mortgages?
All right. Fixed rate mortgages and adjustable rate mortgages. This is a super common question. I'm going to start off by saying, please don't believe the news that you're hearing that adjustable rate mortgages, somewhere to the tune of 1.7 million of them were written. Sorry, KCRA 3, but I don't know where you get your data. It's just not very accurate or applicable. But current article talking about how the world's going to fall apart and real estate will crumble because of all these adjustable rate mortgages being written. Adjustable rate mortgages make up less than 2% of total mortgage originations. And so that's not happening. Now that we got that out of the way, let's talk about the difference between adjustable rate mortgages and a fixed rate mortgage. Fixed rate mortgage, your rate is fixed, which means your principal and interest payment is also fixed. You borrow $400,000 at 7% interest. You've got a principal and interest payment that stays the same month 1, 2, 3, all the way to month 360. The whole 30-year term, you've got the same payment and you've got the same interest rate. On an adjustable rate mortgage, you might have a fixed rate for a certain number of years, 3 years, 5 years, 7 years, 10 years. And then after that, it adjusts. You might see something that says 5-6 arm, 7-6 arm. What the 5 and the 6 represent in that 5-6 arm is it's fixed for 5 years. Then every 6 months, it'll adjust. So maybe for the first 5 years, it's 6.5%. Then after 5 years, every 6 months, there's going to be an adjustment. They're based on different indexes. It might be LIBOR plus 2% or something of that nature. Just know that it's only going to be fixed for a certain amount of time. Then after that, it's going to adjust. When it adjusts, like that's something that, is risky for borrowers. So borrower beware. You don't want to necessarily jump into an adjustable rate mortgage if that causes you any sort of stress, and especially if the difference between an adjustable rate mortgage and a 30-year fixed is very minimal, like it is today, it's just not worth the extra risk to get yourself into an adjustable rate mortgage.
What is a down payment and how much do I need?
All right. How much of a down payment do I need? I need 20% down payment, right? That's the common myth out there on the interwebs. Good news, you don't need 20% down. Plenty of programs that exist and have existed that you can put 0% down on a home, whether that's down payment assistance program from a local county or state program. I've got access to wholesale lenders that provide 0% down across the country. Or maybe you're a veteran and you're eligible for a VA loan, and those require 0% down. There's 3% down conventional for first-time home buyers. There's 3.5% down FHA loans. So plenty of loans out there starting at 0%. To expand a little bit on the down payment question and why it's even needed, the more of a down payment you put, the less risk the lender has. And so as an example, on a $400,000 loan, you might be available to get a 3% down conventional loan where you're putting $12,000 down and you're borrowing $388,000. Well, while that's possible, you're going to have a mortgage insurance payment that's going to be relatively substantial for 3% because the lender has risk. Your interest rate might be a little bit higher as well. And if you think about it from the lender's perspective, that same $400,000 purchase, if you're putting $100,000 down, putting 25% down as a buyer and only borrowing $300,000 from the bank feels a lot more comfortable. They're at a lot less risk, so they can lend you that $300,000 at a lower interest rate without mortgage insurance, and will feel better about it. So while there are different down payment options available, the down payment is something that really the higher the down payment, the lower the risk for the lender, and the lower the risk for the lender, the better terms they're going to give you as a buyer.
I want to expand on this question with a question that I have, because you're talking about the amount of risk the lender takes on. What I don't get is the difference between, let's say, I'm buying a $500,000 home and I'm putting a certain amount down, let's say $50,000. So then the lender is going to put up $450,000. Is that not the same amount of risk as if I bought a $450,000 house and put zero money down?
Really good question, Matt. And I think that the answer is it's not the same amount of risk, because if the lender lends you $450,000 and then an appraisal is done, it's funny because you think about it from a business standpoint. People are always like, well, yeah, the buyer wants an appraisal to make sure the house is worth $450,000. Well, the lender requires it because the lender wants to know that the asset that they're putting up all this money for is worth $450,000. And in the case where you put $50,000 of money down on a $500,000 house, and the bank lends you $450,000, one, they've got this 10% cushion where if values come down 5%, you as the buyer is like, you're still living in a house that's worth $475,000 and you only owe $450,000 to the bank. And so there's some wiggle room. And I think as well, buyers are much less likely to default if you put $50,000 of your hard money into it. And so in those two examples where you've got the same amount of money being lent, $450,000, in one case, the lender has a spread between what they've lent and what the house is worth. And they've got some skin in the game from the buyer to the tune of $50,000, which is, significant amount for most people. And so the bank's at less risk in the situation where they're lending $450,000 on a $500,000 house versus the whole 100%. And quite honestly, this was the argument made about the great financial crash, is that buyers didn't have any skin in the game. There was programs available where not only did they get 100% financing, but they got 103 or 105% to cover all the closing costs. So you could buy a house, put $300 out of your pocket down, and if it didn't work out, values didn't continue to increase over time where you could refinance and do all the things you were able to do in those glory years, 2005 to 2008, then borrowers just walked away. And with good reason, they walked away when they had a huge payment and a house that was worth 60% of what it was worth when they bought it. But in any case, I think it proved that with less skin in the game, borrowers are more likely to walk.
How does my credit score affect my mortgage application?
Very, very good question. So when it comes to credit score, that's really one of only two factors that lenders look at when they price a loan. You can have a lot of factors that go into whether or not you qualify, but after you know that you qualify, the only real things that affect your interest rate and your mortgage insurance, so the terms of your loan, are credit score and loan to value. And loan to value, again, is down payment. If you put 5% down, your loan to value is 95% because you're borrowing 95%. And so when you've got somebody with a 680 credit score and another borrower with a 760 credit score, you're going to get a lower interest rate with a higher credit score, and you're also going to pay less in mortgage insurance. And so the lender, it's all just a kind of risk model. This borrower who's got a 760 credit score and is proven to be really, really financially responsible, we can lend to them at a slightly lower interest rate. We only got to collect $68 a month in mortgage insurance. Maybe the 680 borrower, hey, you qualify. We're happy to lend to you. Your interest rate might be a quarter higher than the 760 credit score, and your mortgage insurance might be $95 a month instead of $68. And so that credit score is going to directly affect the pricing you get. For most people, there's going to be a threshold on minimum credit score for qualifying. That'll vary between VA loans and FHA loans, which are generally the most forgiving. And then most conventional lenders will need at least a 620 credit score to get a conventional loan. And so it factors in minimum credit score to qualify, but then after that, where your credit score lands and which bucket is going to determine the terms you get, mainly the rate.
All right, I have another question from that, just because I don't understand how banks work. So what I don't understand is why banks charge or give you a higher rate when you have worse credit, because doesn't that mean that that's going to create a higher payment for that person, so they're even more likely to default on that payment because it's more money?
Yeah, I mean, it makes sense in theory that it's like, hey, these people, can't afford to pay an extra quarter and a higher payment. But ultimately, I think it's just a function of risk. And, if you ran a car dealership and you said, I'm going to finance everybody that comes through the door, if somebody came to you and they're like, hey, I really need a car, I need to get back and forth to work, they've got a 605 credit score, and it may be various things, right? People that have bad credit scores aren't bad people. They've just, had more instances on their credit where they were having trouble paying the payments. And so higher risk at a 605 credit score, you might still do that loan, but you're going to charge 18% interest because you almost are forced to, because it's a higher risk loan. Somebody comes in, it's got an 800 credit score. And that's why loan to value factors in too, is because if I come to your car dealership and I buy a $20,000 car and I give you $12,000 in down payment, I'm only borrowing $8,000. You can give me better terms because like I've got $12,000 down. I'm not going to stop paying payments on this car. It's much more unlikely than if somebody comes in and says, I can put $1,000 down. I need you to finance 19,000 of it for me. Like it's higher risk. And so it's going to come with a higher interest rate. So while in theory, you would say we need to give the best terms to the lowest scores, we need to keep the payments as low as possible. Really, it's all just modeling based on risk. Lower credit score equals lower risk. Kind of like irrespective of what the reason is. Because trust me, as a mortgage broker of 10 years, I've talked to tens of thousands of people, great people that in a lot of cases didn't do anything wrong. In some cases even got stuff misreported on their credit, but ultimately like that's the model they use. And it just gets plugged into a system that says this credit score, this loan to value, here's the terms.
What are closing costs and how much should I expect to pay?
All right, closing costs. I think there's some confusion around closing costs. So I think this is a really good question. Kudos to ChatGPT for coming up with these great questions. If you have questions, feel free to leave them in the comments down below. I'll either get back to them via another comment or I'll make a video if I got a couple people asking the same questions. So what are closing costs? Closing costs associated with a home loan fall into a couple different categories. And when I talk to people about what to look for in a loan estimate, I explain to them there's going to be the mortgage terms and the lender fees. And if you've ever looked at a loan estimate, they're all the same. Box A is lender fees. There might be processing fee. There might be an underwriting fee. There's going to be points charged for whatever interest rate you're getting. And that's the only thing that's controlled by the lender is box A. Then you've got all the other boxes that might include title fees, appraisal fee, prepaid days of interest, prepaying your property tax and your homeowner's insurance, title and escrow fees. All of that really wraps in, and most often when you hear the term closing costs, it encapsulates all of that. And so on an average purchase, let's call it $500,000, you can probably guesstimate, if you take out box A and lender fees, all the other fees that are charged from third parties, title company, appraisal company, prepaying taxes and insurance to the county and to the insurance company, a 1.75% to 2% estimate is probably a good estimate for all of those things combined. So I just tell people to probably think about 2% on those types of loan balances or purchase price range. If you're $300,000 to $500,000 purchase, then 2% is probably a good estimate. Once you start buying $1 million home, $1.5 million home, that number is going to come down because there's not going to be 2% of a $2 million purchase, $40,000 in closing costs, but account for 2% there. And then when it comes to lender fees, it's all going to depend on what you decide, how much you want to spend up front to buy the interest rate down and whatnot. So hopefully that explained closing costs.
What is private mortgage insurance and why do I need it?
Okay, private mortgage insurance. Some just call it mortgage insurance. PMI more often than not refers to FHA, but I think they're all similar. Whether it's an FHA loan or a conventional loan, mortgage insurance is required on most all loans where you put less than 20% down. And when you put less than 20% down, another misconception too is people think that if you put 3%, 5%, 10%, 20%, you're going to get a different interest rate for all those. What I've seen looking at rate sheets is if you look at 5%, 10%, 20% down on conventional, you're probably going to have the same rate on all three of those. Even though it's different down payment amounts, the lender's, lending you a different amount of the full purchase. Where the lender accounts for their risk and where they are going to charge you more for borrowing more is 5% down. Your mortgage insurance is going to be higher than it is when you put 10% down. And it's really just an insurance policy for the lender to ensure that if something goes wrong on this loan, they've got that little kitty. I remember specifically FHA lowered their monthly mortgage insurance premium. It used to be much higher. And though those funds were put into a pool to cover defaults and foreclosures. And as foreclosure rates and defaults went down, they realized we don't need $7 billion in this fund. We can lower the monthly mortgage insurance required. So if you get an FHA loan today, 0.55% is what most people will be charged on an FHA loan with 3.5% down. And that's just the standard mortgage insurance that you pay as kind of a little insurance policy to the lender where, hey, I might default. And if I do, put this to the side. And then when it comes to conventional loans, it's not a fixed number, but it's a varying number depending on your credit score. If you've got a 780 credit score and you're putting 10% down conventional, you're going to pay very little in mortgage insurance. You put 5% down, you're going to pay a little bit more. You put 3% down, you pay a little bit more. If your credit score is 695, you're going to pay significantly more. And so this is where it really pays to talk to somebody who knows what they're talking about, because you can look at your credit score, your down payment, and then compare side to side which one makes most sense, FHA or conventional. It used to be, when the mortgage insurance was higher on FHA, that if you had a 720 credit score or better and you're putting 3% down or more, you'd go conventional. With mortgage insurance coming down on FHA, it's a lot more competitive with conventional. So it might mean that, 740 plus and 5% down plus, the terms might look better conventional. And, under 740, less than 5%, you might be leaning more towards FHA. But this stuff moves every day. FHA loans and rates change every single day. Conventional changes every day. So another one of those things where you've got to talk to somebody you like and trust to get the best advice. But mortgage insurance, something that's required on loans with less than 20% down, except for that VA loan. VA loan, no mortgage insurance.
What documents do I need to apply for a mortgage?
All right. What documents? This is a great question, and it's forgotten sometimes, especially I think lenders like myself. We work for great companies that have great technology, and the technology does all the work. You fill out the application, it requests the supporting docs. But if you're a W-2 employee, most people are, the documentation is pretty simple and standard. We're going to require the last couple years W-2s. So as we sit in 24, where you want 22 and 23 W-2s from your employer, we want 1 month of pay stubs covering 30 days. So if you get paid once a month from the state of California, just provide us with 1 pay stub from them. If you get paid every 2 weeks, you might have to provide us with 3 to cover a full 30-day period. If you get paid twice a month, 2 pay stubs will be fine. A copy of your ID, and then 2 months of bank statement wherever the down payment is coming from. And that's really it. Bank statements, W-2s, pay stubs, ID, and if you've got alimony, if you've got income from adoption assistance, if you're self-employed, we're going to require the tax return. If you're somebody who owns multiple properties that show up on your Schedule E, we're going to need the tax return. And so there's variance to it depending on how your income is sourced, but that's the basics of what documentation is going to be needed. And talking to a great mortgage broker, they're going to guide you and say, we need this document. Here's the reason why. Once you collect all that documentation and you get yourself pre-approved, lender says you're good to go buy something up to $700,000 with 5% down. Know that once you submit the loan to a lender, they're always going to ask for other documentation. They're always going to have conditions that they ask for. So don't be afraid if you're in contract and they're asking you for more stuff. It's just the nature of the beast.
Can I pay off my mortgage early, and are there any penalties?
Great question. I think that the pay off the mortgage early is something that's going to come back into style, especially with higher mortgage interest rates, because the higher the mortgage interest rates are, the more incentivized you should be to pay off your mortgage early. Most every mortgage that's written nowadays doesn't have a prepayment penalty, meaning you can pay extra payments, you can pay the loan off in full, and there's no penalty to do it. And I highly encourage you to do it. I just saw something the other day, and this is going to depend on how long of a term you have, what your interest rate is, but on a mortgage today that might be at 7%, if you make 1 extra payment a year, you'll pay that thing off in 24 years versus 30. The example that I saw, a person saved $165,000 in interest. And so it's not only allowed, and there's no prepayment penalties, but it's highly encouraged. And for somebody like the example that I saw, it was actually another loan originator that posted it, that extra $3,300 a year payment that saved this person $165,000 in interest and took 6 years off the back of their loan. What I like to do, and what I would encourage somebody to do, is you might not be able to find an extra $3,300 laying around once a year, but if you divide that by 12 and tell yourself, I'm going to put $280 a month extra towards my mortgage, just put that. Most online payment that mortgage companies have set up will allow you in that box that says extra principal payment, put that $280 amount. So your normal payments, $3,220, put an extra $280 towards it, and now you're paying $3,500, and you won't miss it. You won't even notice it after a while. You just got a payment of $3,500, but that extra $280 in principal is really knocking off that principal balance a lot faster than it would on its regular amortization schedule. And you'll be out of this thing in 24 years. You'll probably be so excited to see that principal pay down happening and things going down that you might decide in a couple of years to bump that up to $480 extra a month. But no prepayment penalties on most all loans that are being written nowadays. I can't think of one that I've written, at least on the standard mortgage side. Non-QM loans, DSCR loans, those type of loans, those come with prepayment penalties. But for the loans that most folks are getting, no prepayment penalty. It'll say it right on your loan estimate if there's a prepayment penalty. So you can check that and ask your loan originator. If you don't have it, go ahead and pay extra payments. Even if you paid an extra $75 a month, $125 a month, you'd be surprised how much you save over the long run.
What is an escrow account and how does it work?
What is an escrow account and how does it work? Man, I should direct everybody to my escrow video I have on YouTube. So if you have some time, type in what is an escrow account, Matt the Mortgage Guy, find it on YouTube. But the basics of it are when you get a mortgage, you're required to have homeowner's insurance per the lender. And it's probably something you want in case your house burns down. And you're going to have to pay property taxes as a homeowner. Those two things, homeowner's insurance being due once a year, property tax being due twice a year, you can decide to opt out and waive escrows and pay those on your own. Most people pay them through their mortgage. And how that works is you pay a little bit per month that goes into this escrow account. And then every 6 months when the tax bill is due to the county, the mortgage company just sends that $2,500 to the county. And then when the homeowner's insurance bill is due once a year, and that's $2,000, they send that $2,000 directly to whatever it is, Mercury Insurance, AAA, whoever you have insurance with, they send that directly on your behalf. So it's a budgeting tool built into your mortgage where rather than pay $2,500 twice a year and $2,000 once a year to pay your tax and insurance, they say, we've got $7,000 in payments that need to be made. Let's divide 7,000 by 12. Put myself on the spot. 580, somewhere in there. It's less than 600. It's probably 580 or 585 a month is going to be included in your mortgage payment. So principal and interest might be 2,000, 580 in escrows. And so your total payment is 2,580 per month. 580 of that is being put into this quasi savings account, escrow account, and then $2,500 a month twice a year is being sent to the county for your property taxes. $2,000 a year is being sent to whoever holds your homeowner's insurance. And so everybody's free to do what they like. I highly suggest you use an escrow account. It just makes it easy. Everybody's like, it's my money. I don't want someone else holding on to my money. But it's a free budgeting tool by most mortgage loan servicers. And so I'd take advantage of that and just put it on autopilot.
How does refinancing a mortgage work and when should I consider it?
This is a good question. I think this is going to be a hot question in 2025. How do mortgage refinances work? So mortgage refinancing is basically taking out a new loan. This new loan is going to pay off your existing mortgage, and you're going to have a brand new mortgage, brand new company, most cases. And so let's say that you took out a mortgage for 7.75% in late 2022. Rates were up there then. And you're 2.5 years into it in early 2025, and you hear mortgage rates are coming down. You follow Matt the Mortgage Guy on YouTube, and you're like, I'm going to reach out to Matt and his team, and where are mortgage rates at? We type in all your numbers, and we say, well, we could get you a 5.875 on a new 30-year fixed rate mortgage. And that's going to save you, coming down almost 2% on that mortgage is going to save you $425 a month. Well, what I like to do with clients, what I did so much of in 2020 and 2021 is say, how much does this refinance cost you? Because no matter what anyone tells you, refinance cost. Title companies are not nonprofits. They charge you something. There's going to be some level of charge from the lender. On a lot of refinances, there's going to be an appraisal that's needed. So you might have $3,000 or $4,000 of costs baked into it. But if you're saving $425 a month, you can do a quick break-even analysis and say, this thing's going to break even in 10 months. If I plan on staying in this house for more than 10 months, it's probably a good idea to refinance. And so that's what is the indicator for me on when to refinance, is you have somebody run the numbers for you and do the break-even analysis. How much am I saving per month? How much does this cost me? How long is it going to take me to break even? If you're saving $120 a month and it costs you $6,000, well, 50-month break even is quite a long break even. Maybe you've got to wait until rates come down to a point where your break even is 36 months or less. I think 36 months or less is probably what I would advise. In most cases, I'm looking at refinance right now where I'm advising somebody, here's a 13-month break even, a 15-month break even, and you go from there. And so a follow-up answer to a question you're likely to ask is, aren't I starting over? I just got 2.5 years into this 30-year fixed rate mortgage. Now you're telling me I'm going back into a 30-year? A lot of lenders I work with offer flex term. I could give you a 27-year, a 28-year, and it might be you've got 27.5 years left. I'll take you to a 26-year, lower that rate, and you're still saving $350 a month. So we can shave term off of your loan. A lot of people did this in 20 and 21 when rates were really, really low. They had 23 years remaining in their mortgage. And by lowering the interest rate and going to a 15-year, they were able to lower their payment, or in some cases keep it the same, but shave 8 years off of their mortgage. So there's a lot of different ways to do it. And it's not always, necessary to shorten your term, but it's definitely possible.
All right, that was the 10 most common questions. I've got 10 more rapid fire bonus questions here.
Let's do it.
You need to answer these in 30 seconds or less.
All right.
Number one, what is an amortization schedule?
Amortization schedule. How much every month is going towards your principal and how much your interest and how much is remaining. That amortization schedule lies in your final loan documents. It's kind of cool to look at. You can see, like, in year 15, I'm going to owe $285 or $285,000 on this $375,000 loan. So it's just a schedule of your payments from payment 1 to 360 on a 30-year fixed, on how much you're paying per month, what's going to principal, what's going to interest, what's remaining.
What is a jumbo loan?
A jumbo loan is a loan that's, depending on the county you live in, above those county loan limits. It might be $766,550. In a lot of parts of the U.S., it might be as high as $1.1 million in some of these high balance counties. But once you get above that high balance limit, you're in jumbo loan territory. And so you're going to need a jumbo loan.
How long does it take to close on a mortgage?
Most companies that I work with as a wholesale, mortgage broker can close loans in 15 days, 17 days, 18 days. I think the average in the industry, Matt, I don't know if I believe this. I heard it's 40 something days, but great lenders can close loans in as little as 15 days on super clean files, and we're generally writing contracts that are 21 or 22 days long.
What is a home equity loan?
Home equity loan is a loan based on how much equity you have in your house that sits behind that first mortgage. Example, $500,000 home. I owe $300,000 on my first mortgage. I'm going to go get a home equity line of credit because I've got $200,000 in equity between the $300,000 I owe and the $500,000 it's worth. Home equity loans come in all different sorts. Some are fixed rate, some are variable, but it's a loan that sits as a second lien on your property. And so you got to have home equity. You got to have equity in your home to get that home equity line of credit sometimes.
What factors can affect my mortgage interest rate?
Most common things to look at for what's going to factor your interest rate is the loan type. There's different loan types: FHA, VA, conventional, debt service coverage ratio, bank statement loan. That's going to affect it. Your credit score is definitely going to affect it, and your down payment is going to affect it.
What is an interest-only mortgage?
An interest-only mortgage, not very common nowadays, but when you look at a mortgage payment, and I tell you you're going to borrow $700 $100,000 at 7% interest rate, there'll be some of your payment that goes to principal and some that goes to interest. There are some companies that allow you for a certain amount of time to only pay the interest portion, which means nothing's going towards principal, nothing is paying down. After 3 years of paying interest-only payments on that $700,000 loan, you still owe $700,000. It's more common to have a 40-year term where the first 10 years are interest-only. I don't know if I advise that. It's really, really like a small sliver that would utilize that, and it would make sense for.
Can I use gift funds for a down payment?
Yes, you can use gift funds for a down payment. Not enough people know about this. So if you didn't know, tell your friends, tell your family, tell everyone you know. Gift funds are totally allowed and encouraged. Most first-time home buyers, they don't have a big down payment saved, but maybe grandpa out in Texas has some funds that he can gift you towards the down payment. Or maybe mom and dad are like, hey, you're doing good. You graduated college. You're starting a family. We want to give $10,000 in gift funds towards your home purchase. Definitely allowed on a primary purchase, and encouraged probably. Go find a rich family member that'll help you out.
What is a reverse mortgage?
A reverse mortgage is something that generally is utilized by the older demographic, where instead of paying a mortgage payment every month where your balance is going down, you owe less and less. You're taking an existing mortgage that is very low compared to the value of your home. And each month, it's going in reverse, I guess, right? Where you owe more and more. But the positives to that is, as a homeowner who's, really fixated on what the monthly cash flow is, you, in most cases, don't have any mortgage payment at all. So you get to keep more of whatever type of income you have, whether it's Social Security or whether it's other forms of income. And so it's a cash flow play for the older demographic. That's my best explanation for a reverse mortgage.
How do mortgage points work?
Mortgage points, very common question. You hear the term points. What do points mean? What are they? If you talk to somebody and say, what's my interest rate? There's no answer for what's my interest rate. It's a whole spread of interest rates. If you come to me and say, I've got an 800 credit score, I'm putting 10% down on a $500,000 purchase, I will show you the full rate sheet that comes from 6% all the way to 7.5%. And maybe to get the 6.99, you pay 1 point. To get the 6.625, you pay 2 points. 1 point equals 1% of the loan amount. So in the example I just gave, the 6.99 that cost 1 point, if you borrowed $450,000, would be $4,500 in cost. You want to spend another $4,500 and pay 2 points, you can go down to a 6.625 interest rate. What you want to think about, again, on whether or not to pay points is, what's the break even? If it cost me $9,000 to get to 6.625, but it's going to be a 85-month break even on what I save every month versus the cost of that, maybe you take a higher interest rate, pay a higher payment, knowing that you're likely to not be in this mortgage 2 years, 3 years, 5 years from now. This is where great advice really comes in handy.
Final rapid fire question. What is a mortgage rate lock?
Mortgage rate lock is once you've got a property identified, you've submitted an offer, and you've got an accepted contract, you contact your lender and say, here's the contract, I want to lock the rate. You lock in that interest rate. What most people don't understand is you don't only lock in that interest rate, you lock in the whole rate stack, which is what I talked about, where you can choose to pay points and get a lower rate. You can choose to pay no points and get a higher interest rate, but you're locked into that whole rate stack to where next week, depending on what Jerome Powell says or what the Fed does, interest rates go up, it doesn't affect you. You're locked into the rate from the day that you locked it. Some rate locks are 30 days, some are 45 days. Your loan originator will lock it for the length of times needed to close your deal. That's a rate lock.
That's all the questions I got.
All right. Whew, man, rapid fire makes your mouth go dry. All right. I think that's a wrap, man. I appreciate the questions. That was fun. If you have questions, like I said, leave them down in the comments below. Fire me an email if you've got it. I'm happy to answer questions either in the comments or by making a video. Again, if you want to connect me and my team, go to greatmortgagebroker.com. Happy to help.